Hi, it's Frank from CappThesis. Today I'll be looking at the market's positive momentum across various time frames, how this has helped bullish patterns and hurt bearish patterns. And at the end, we're going to examine one specific short-term metric that needs to persist in order for the market's bid to be sustained. So let's first look at this daily RSI chart. It's very familiar to all of us, and as we know, most recently, as the market has been making new highs, the RSI has not. Now, it's still very close to being overbought, but it's pretty clear that we've seen lower highs take place over the last few weeks. And so it's a negative divergence that we have to pay attention to. We can't ignore it, even though we know that the most recent one, which was even more apparent, failed as well. This is really about the market being able to digest short-term respites, regroup, break out, and move higher from there. And that's what it's all about. And so we have to, of course, understand the fact that sometimes momentum will need to slow first before rolling over, but also recognize the fact that that hasn't mattered just yet. And really what's much more important is the fact that even as the RSI momentum has slowed, it has stayed above the midpoint of the range the entire time. And we have highlighted in blue here the first time that it was able to go back above that midpoint after the October low, of course, and oscillating between overbought, very overbought here at least, and the midpoint the entire time. And that is, again, the epitome of an uptrend from a 14-day RSI point of view. And we saw the same type of thing take place from the March lows after the RSI got back above the same midpoint, stayed there, wasn't as clean, right? It dipped below it a little bit for a few days, but then stayed noticeably above the midpoint, oscillated between that and overbought until things rolled over. And we talked about how just paying attention to how the index does near its long-term trend line here is important. Needless to say, when that was breached back in August and coincided with the RSI going back below midpoint as well. And we can see this from a very short-term point of view too. We've seen this chart many times. So as the daily RSI has stayed above the midpoint, the very short-term 14-period RSI on a 2-hour chart has stayed above oversold. And really seeing both of those occur at the same time wouldn't be surprising, because as we have here, at the same point when the S&P first hit oversold after being above it for many months, coincide with the market rolling over, we can see here just about the same time. So when we see the 2-hour RSI hit oversold territory, it may coincide with the 14-day RSI getting close down to that midpoint once again. And we'll pay close attention to both of those, considering what that could mean. Now, zooming out, this is the weekly, the 14-week RSI. And even though the daily indicator hasn't been overbought in a few weeks, the weekly indicator hit 75 at the end of the last week, which now is the highest point we've seen since it hit 79 back in January 2020. So, of course, not the best look here, considering that that was right before the COVID crash, but we know that was more about an extreme outside force than anything else at that point. What's more important is to look at the prior 4 times in aggregate since the low from the great financial crisis in 2009. And not surprisingly, it happened after some strong periods. So going back in time, February 2011 led to just really sideways movement for 6 months until the big August volatility occurred, which really stayed with us for a number of months. We then saw it occur in the springtime 2013, and really that did nothing to upset the uptrend, which was really in place from that October 2011 low all the way until at least the October correction of 2014, right? And so again, this just was really just something that occurred within a long-term uptrend. And then the next time we saw it was in October 2017. Now, I think this one's interesting because 2017, as we know, was the most consistent non-volatile uptrend in history, if judged by how far or how close the index stayed to stayed near a high at any point. But things got really overheated as the fourth quarter ended, as 2017 concluded, and as January began, which then took that RSI, which had just hit 75, all the way up to 90. Very extreme, especially from a weekly basis. And as we know, that was really right before the vol implosion of late January, early February. And again, the last one being right before COVID. So it tells us that there's been very different outcomes over the last 4 times. It's really about, number one, seeing how the market can take a punch on the way down the first time a material decline happens, and also just seeing how far this indicator extends to, right? The last ones didn't get to 80. However, this one got to 90, right? And so that came with extreme daily moves as well, because all the way through 2017, as you recall, there were only 8 to 1% moves all year, 4 up and 4 down. And we finally got, again, things that overheated toward the end of January, giving us an indication that there was more emotion tied to it. Clearly not a sign that the big vol implosion was going to happen, but that the character change was taking place. And so all of that then has continued to help the S&P rally. We can call this a wall of worry, and we can see that anytime there was a new high hit and the market came off of it, couldn't have been a top. Obviously, it hasn't been. But looking at this is just seems like an uptrend. We have to drill down into the daily or the intraday price action to get a better idea of what was going on. And these are some of the bearish formations that we have profiled in CappThesis, trying to understand when things are going to change, knowing that just because the market pulls back or pauses isn't going to give us an indication, even though a lot of different things we look at suggest that it could be overextended. And so one of the things, a very important part of this whole process, is finally seeing a pullback develop into a bearish pattern, have that bearish pattern broken, and the downside target hit, because the definition of a successful bearish pattern is seeing a downside target acquired. And as we can see from all of these, we never even had a downside break. And starting from down here, from back in November, we saw one fail. Again, December, January, February, all the way to right now. Once again, we know one of these times is going to happen. Understanding that it hasn't is instructive as well. It just tells us that momentum continues to be there. Investors continue to want to buy the dip until proven otherwise. So when bearish patterns fail, you know where we're going with this. Bullish patterns work. We've showed this before, but again, very important, because at some point, one is not going to work. And so all along the way, we've achieved upside targets of bullish patterns. Most recently, we had a breakout just a few days ago, which would target 5180. Market is still trying to capitalize on that. Not too far away, of course, but important to realize, because we want to see more of these continue to work in order to get to keep our confidence high that the trend is still with us. And so this is what this looks like close up. We know that we just had the one that had a target hit from before that. And of course, we'll continue to show the much bigger breakout as long as it remains in place. And again, the market would have to come down and breach 4,800 for this one to be voided. And so again, what causes all of this to occur? And we always talk about the very short term as well. It's very important, because it's really get a sense of how aggressive and how bullish traders want to be throughout the trading day. And when we see good closes over and over again, it just tells us that the trend continues to be strong. And one way to look at this is the reverse, of course, is looking at how many times we've seen closes below the midpoint, and really how that has worked as a trend, meaning that we just had 2 straight closes below the midpoint. It's happened before, not a lot. You know what hasn't happened in a long time? More than 2. And if you think about it, more than 80 trading days so far during this run, only one time the entire way have we had more than 2 straight closes below the midpoint. And that was just these 3 from January 3rd to January 5th, right? And so we know we're going to get some pullbacks along the way. Those pullbacks have been bought. We know we're going to get some bad closes. We know we've gotten some bad breath. All of those have been short term. We haven't had a downside follow through of any of them. At some point, that's going to change, and we'll be keeping tabs on it. That's it for today. Check out these videos and subscribe, and I'll talk to you next time. Thank you.